Okay, welcome back. We were discussing LKAS 32. Now we are going to start SLFRS 9. SLFRS 9. Take 2 pages, and middle of 2 pages you can write SLFRS 9 financial instrument. Financial instrument. SLFRS 9 financial instrument. Okay. First, we should understand the scope of the standard, right? Scope of the standard. Take your red pen. Take your red pen and we'll eliminate irrelevant things. We'll eliminate irrelevant things. Right now, this is, in this case, we need to, as I mentioned before the break, I was explaining what we are going to do on financial instruments, SLFRS 9, right? Financial instruments need to be recognized, right? We should know how to recognize initially, and we should know how to de-recognize. What are the circumstances where de-recognition of financial instruments, right? Recognition, de-recognition. Then, after discussing that, we should discuss classification of financial asset. Financial asset, there are 3 types. Amortized cost, then fair value through OCI, then fair value through P&L. Those are the 3 classifications on financial asset. When it comes to financial liability, there are 2 classifications. First one, fair value through profit and loss, and the amortized cost, right? Okay, financial equity, only one, financial equity. That's a residual figure, no? That's a residual figure, okay? Based as per the definition of financial equity instrument, okay. Then each and every financial assets as well as financial liabilities, we should discuss initial measurement and the subsequent measurement. Initial measurement, subsequent measurement. Okay. So those are the things that we need to discuss. In addition to that, we should discuss impairment of financial asset. Impairment of financial asset. So those are the things that we need to discuss, right? Since we are discussing measurement, recognition, measurement of financial instruments, we should eliminate irrelevant things, right? Irrelevant things. So we'll focus on that. We'll write or we'll discuss one by one. First, we need to eliminate what? Subsidiaries, write down. Subsidiaries, joint arrangements, associates, subsidiaries, associates, joint ventures, subsidiaries, joint ventures, associates. Same thing we discussed under LKS 32 as well, right? So I'm not going to take much time. SLFRS 10, LKS 28, SLFRS 11, those are the relevant standards. Then rights, employee rights as per LKAS 19. 19, right? Rights and obligation. Rights and obligations under employee benefits. LKAS 19. Okay, LKAS 19. Then rights and obligation under leases. That's new, right? Rights and obligations under leases. SLFRS 16. SLFRS 16. However, receivable component, right? There is a receivable, receivable in the lessor's point of view, right? That one need to be measured as per SLFRS 9. So you can highlight in the textbook, come to page number 7. Come to page number 7. Come to page number 7. Rights and obligations under leases, which SLFRS 16, lease applies. However, lease receivable recognized by the lessor are subject to derecognition and impairment requirements of the standard. Subject to derecognition and impairment of, right? Receivable on the lessor's book, right? Lessor's book. Derecognition and impairment. Derecognition and impairment should be performed. Should be performed based on the standard. The standard means SLFRS 9, SLFRS 9. Okay? Read and understand. What else? Now, other than that, eliminate from the scope SLFRS 16 because there is a standard, no? We need to use SLFRS 16 for, leases. Already we have done that. Already we have done that. Because there is also, relationship. There is a contract. Okay? Then insurance contract. Write down quickly. Don't take much time. Insurance contract. Insurance contract. SLFRS 4. SLFRS 4. Then share-based payment. Share-based payment. SLFRS 2. Then, sometimes we can sign an agreement between, acquirer and acquiree. Acquirer and acquiree when it comes to business combination, right? Forward contract with acquirer and acquiree in the business combination. In business combination, there is a specific standard that is SLFRS 3. SLFRS 3 business combination, right? So those things would be discussed under SLFRS 3. No need to use SLFRS 9. Okay? What else? We need to discuss, we need to eliminate from this scope rights and obligations in revenue. Revenue contract. SLFRS 15. SLFRS 15. Rights and obligation in the revenue contract. SLFRS 15. Right? Now almost all items we have listed. The scope. Without these items. No, these are out of the scope, right? Out of the scope. Right? Out of the, that's why we have used red color. That's why we have used red color. Okay? Then what we can do, already you know the classification in the sense financial instruments already classified, no? Financial asset, financial liability and financial equity. Already we have defined. And we discussed in detail about the classification of financial liability and the financial equity. Right? Financial liability and the financial equity. We focus on the substance rather than the legal formality. Right? And the second one, we focus on the definitions of financial liabilities and the financial equity. Right? Based on that, we we calculated liabilities as well as equity components. Right? Okay. Now you can understand the objective of financial instrument, this standard. What is the objective of this standard? Take your highlighter. Highlight the objective of SLFRS 9. I'm not going to write here because that's wasting the time. So just highlight. The objective of this standard is to establish principles for the financial reporting of financial assets, financial liabilities that will present relevant and useful information to the users of financial statements for their assessment of the amounts, timing and uncertainty of the entity's future cash flows. Okay, highlight it. Okay, when I'm explaining, I told you the objective of financial reporting. More or less similar thing mentioned here. Right? So as accountant, we should provide financial information to the parties or stakeholders of a business. Right? So that's objective. Okay? So this, particularly this SLFRS 9, very interesting, very important standard in the accounting standard list in the world. Right? I already in the beginning I told you the importance. More than 70 or 60% of items in the financial position statement cover through these standards. Not only this set of standards, LKS 32, SLFRS 9 and SLFRS 7. Okay. Now what we are going to do is we need to focus on recognition of financial instrument and derecognition of financial instrument. Okay. So we can take here recognition. Recognition of financial instrument. Right? And derecognition of financial instrument. Recognition of financial instrument and derecognition of financial instruments. Okay, write down it quickly. Okay? Shall we discuss recognition of financial instrument first before derecognition? Okay. We'll write that one bit upper, right? Otherwise people cannot see. Recognition of financial instrument. This side, derecognition of financial instrument. Right, that one we can divide into two: financial asset derecognition, financial liability derecognition, right? This one we can divide into two, but recognition of financial instrument, simply we can talk about as together, right? Financial asset and financial liability. Financial asset and financial liability, right? In this case, initial measurement, initial recognition. How we are going to recognize initially, right? As you already know, there is a contractual arrangement, right? There are two parties basically. There is a contractual arrangement existing, right? So based on the contractual arrangement, if they are, becoming a parties on the contractual arrangement in that particular date, they can recognize financial asset as well as financial liabilities, right? Financial asset and financial liabilities. So what do you mean by that? Now we were discussing about, debt instruments. Financial liabilities we were discussing. Financial equities we were discussing. Okay? So sometimes we need to take transaction date. Okay? Transaction date is the date where the people are becoming in the contractual arrangement. Okay? Transaction date. On the other hand, settlement date. Right? Settlement date. Okay, based on the instrument, it may be applied. Okay, so initial recognition of financial instrument should be in which date? The date where people are involving with the contractual arrangement, right? Shall we write it? We'll write it. Financial asset or financial liability, financial asset or financial liability is recognized in statement of financial position, statement of financial position, SFP, when reporting entity becomes, when reporting entity become a party to the contractual provision. Contractual provision. Contractual provision of the instrument. Of the instrument. Of the instrument. Right? That is recognition as financial asset or financial liability, because already I mentioned there is a contractual arrangement. Contractual arrangement. So if reporting entity become a party on that particular contractual arrangement, then that particular reporting entity should recognize financial asset or financial liability initially. Initial recognition is easier than derecognition. Derecognition, there are many things to be discussed. Derecognition, there are many things to be discussed. Recognition easier. Recognition easier. Okay? Then when it comes to measurement, we'll discuss one by one. This is recognition. These are the conditions to be satisfied. Okay? I hope you understood. I hope you understood. Right. Then we'll talk about derecognition. We'll talk about derecognition of financial instrument. Divide this one into two. Financial asset, financial liability. Take down this one quickly. Okay. Shall we discuss derecognition of financial instrument, right? Derecognition. Now we were discussing recognition of financial instrument, financial asset as well as financial liability. Now focus on derecognition. What are the circumstances where we are going to remove financial assets as well as financial liabilities from the books? Financial asset derecognition is more, how to say, I'm not going to say more complex, but there are things to be learned, right? There are things to be learned on financial asset derecognition than financial liability derecognition. Okay? Okay, now we'll take an example. Financial asset. Let's say financial asset FD. We have FD, fixed deposit. Can you please guess what are the circumstances? What are the circumstances where we are going to remove that FD from the books, from the statement of financial position? One thing we can say, we came into the end. That means maturity, finish, right? That means as per the standard, I can say the contractual right to receive cash or any other financial instruments or any other financial assets is expire. Right? That's based on the standard. In our simple terms, day-to-day words, we can say fixed deposit, we came into the maturity. Suppose we invested on 5 years, we came into the 5 years. Now, we are in 5th year, end. Expire, we need to remove it. That's one. Another one. Another one. Can you transfer, now if some financial assets can be transferred. In simple terms, selling. We are the holder, we can sell it outside. Right? If we are going to transfer financial asset, then what we need to do? We need to derecognize. We need to derecognize. Right? In that case, we should check whether risk and rewards of the financial asset transferred from seller to buyer. Right? For that, we need to use a decision tree. We need to use a decision tree. Right? That's why I said there are things to be learned. There are things to be discussed. Many things. But financial liability, only 3 things to be discussed. Right? When it comes to derecognition of financial liability. First, focus on financial asset. Right? Shall we write down financial asset? Basically, could be derecognized on two reasons. First one, as I mentioned, contractual right. Write down contractual rights to the cash flows. Contractual right to cash flows. That means contractual right to receive cash flows from the financial. Contractual right to receive the cash flows from the financial asset is expire. Right? Second one, the entity transfer financial asset. In that case, we need to check risk and rewards. In that case, we need to check whether risk and rewards of financial asset transferred. Risk and rewards transferred. Right? These are the things that we need to check. Right? Particularly risk and rewards. This one need to be done through decision tree. Have you heard about decision tree? Yes, no. This is symbol for the decision. If yes, no. Likewise, we have to ask couple of questions in order to ensure whether risk and rewards of financial asset transferred from seller to buyer. Right? Okay? Note down these two. Remember, in the very beginning I told you, in these financial instruments we use substance over form rather than legality, right? Legal form, right? So I'm not going to say again and again. In the very beginning I told you substance, right? Substance. You need to use your common sense, right? okay, substance of the transactions, financial assets, financial liability, because we are running through what? Contractual arrangement, contractual provision, okay, contractual provision, financial asset as well as financial liability. Okay, now financial asset could be derecognized. This is the first circumstances. Contractual right to receive cash flows expire. For an instant, I gave an example as well. Next, second one, the entity can transfer financial asset. Entity can transfer financial asset, right? If we can, directly say risk and rewards transfer, then no problem. But sometimes we need to check who has the risk and rewards of the financial asset, right? Maybe it has been transferred. Now we need to check through decision 3, right? After checking through decision 3, we can ensure, yes, entity has to derecognize. Entity has to derecognize the financial asset. But we need to go through the decision 3. Shall we discuss decision 3? I will take this side. One, two, three, 4, 5, 6. But we have to have space in between circles. 1, 2, 3, 4, 5, 6. Right? First circle, we'll write one by one. Rights to cash flow expired. Rights to cash flow expired. Rights to cash flow expire. This is a question, right? Now we need to answer. Rights to, you can put the rights to receive cash flow, right? Expire or not. This side you can answer no, this side you can answer yes. If yes, what is the conclusion? If yes, what is the conclusion? If yes, is this visible? Is this visible? Yes, right? Derecognize. If yes, derecognize. Derecognize. If no, then we need to ask another question. Here no, right? Answer is no. Rights to cash flow expire? No. Then we need to ask another question. If yes, directly we can derecognize the asset, right? If no, we need to ask second question. What is that? Transfer of rights. Transfer of rights. Transfer of rights. Transfer of rights. Here also, answers, expected answers, transfer of rights. Now we are here, right? Transfer of rights, financial asset transferred. Okay? Answer is no. Transfer of rights, no. Right? Then we need to check whether risk and rewards are transferred or not through the question. We'll see the questions. Obligation to pay cash flows. Obligation to pay cash flows. Here, obligation to pay cash flows. Obligation to pay cash flows. let me write one by one, then we will be able to understand quickly. Risk and rewards transferred. Risk and rewards transferred. Risk and rewards transferred. Okay. Then risk and rewards retained. Risk and rewards retained. Retain with the entity. Last one, control retained. Control retained. Right? Control retained. Now already rights to cash flow expire if yes, derecognized. If no, we need to see whether we have transferred asset or not. Transferred rights, transfer of rights, no, then we need to see the obligation to pay cash flows. Obligation to pay cash flows. Obligation to pay cash flows in sense whom? Now if we transfer asset, someone should pay us, right? Someone should pay us, right? So obligation to pay cash flows. Then let's say yes, if yes, in this side, no. There is no obligation to pay cash flows. There is no obligation to pay cash flows. Then I use blue color. What would be the answer here? There is no such obligation to pay cash flows. Can we derecognize? There is no such obligation to pay cash flows. That means outsider, there is no obligation to pay. We can continue, right? Continuing recognition, right? We cannot derecognize the financial asset, right? So continue to recognize. Here you can write continue to recognize. Continue to recognize. But here, obligation to pay cash flows, yes. Yes. Then we need to check risk and rewards transferred. There also we have two options, yes or no. Risk and rewards transferred. What are the answers? If yes, derecognize. If yes, derecognize. Derecognize. If yes, derecognize. Right? If no, then if no, risk and rewards retained. Still we have. Right? Then what we need to do? Then what we need to do? If yes, here risk and rewards retain, yes. I would use blue. Yes. Then your answer should be continue to recognize. Continue to recognize. Continue to recognize. Continue to recognize. Right? If no, risk and rewards retained, no. Then what we need to check? Control retained. The control of the asset. You know, if yes, no problem. If yes, we can continue, but no. Control retain, no. Then, derecognition. Derecognize the financial asset. Okay. If yes, in this case, if yes, continue to recognize. Continue to recognize. Okay. Now let me show you risk, and now this is risk, rights to cash flow expire now. This is this part, right? From this here onwards, here to here, risk and reward test. Risk and reward test. I hope you understood. Very clear, right? Very clear. So what are the circumstances where we need to de-recognize the asset? De-recognize the asset. This is called decision tree. Decision tree. Here decision tree. Decision tree. Okay. With that, financial asset de-recognition done. Financial asset de-recognition done. So all these two items covered on this decision tree. Okay, now we'll move to financial liability. Financial liability de-recognition. Okay, shall we start, or sometimes students might write, still writing, you can focus decision tree. Those who are writing, I will give couple of minutes. Or else shall I explain again quickly? This is important. There are 6 circles. First one, rights to receive cash flow expired. That is the question. If yes, de-recognize at once. One shot, de-recognize. If no, we need to ask second question. Right? Transfer of rights. Then we need to get the answer no. Right? If no, then we need to see the obligations to pay cash flows. Right? If someone has an obligation to pay cash flows, right? Then if no, continue to recognize. Right? Continue to recognize. This one can be, think on both way. How? If we have an asset, we have right to receive cash flows, no? Right? We have a right to receive cash flows. If that is FD, we should receive interest. Right? We should receive interest. Okay? Who has the responsibility to pay something? Who has obligation to pay? The bank. Right? So we need to check obligation to pay cash flows. No, continue to recognize. If yes, then we need to check risk and rewards transferred. If yes, de-recognize, no problem. If no, we need to check risk and rewards retained or not. If yes, continue to recognize. If no, we need to check the control. Who has the control of the asset, financial asset? If retained, yes, continue to recognize. If no, de-recognize the financial asset. Right? I hope you understood that one. Here we have missed one part. Transfer right, yes. If yes. Transfer right, if yes, we need to check risk and rewards, right? If yes, we need to check risk and rewards, because here we discussed no. If no, we need to check the obligation to cash flow. Then in this case, yes, risk and rewards. But directly we can check this one, because we have not discussed yes part. Transfer right, no only. So we missed. So you need to take like this. Yes part, we can shift this box. This circle can be skipped. Right? Directly you can come to here, because if they transferred rights, we need to check whether risk and rewards transferred. Right? Risk and rewards transferred. Okay? Please correct it. Correct in the sense, complete that. Please complete that. Okay. With that, this picture is completed. This decision 3 is completed now. Okay. Now, financial liability. So financial liability is not complex, very simple when compared with financial asset, right? There are 3 circumstances where financial liability is derecognized. First one, discharge. Discharge. Now, suppose you are in a hospital. Discharge means what? So you can go home. Likewise, suppose we have a liability. We have a, let's say, a creditor. Discharge in sense what? When we settle that liability, at the date of settlement, we can discharge that. That financial liability can be discharged. Right? That is the meaning of discharge. Next one, cancel. Cancel. What do you mean by that, cancel? So we have a contractual obligation. So some outsider can cancel. Legally, it can be cancelled through the agreement. Maybe the court order came, you should not pay. No need to pay. Like something like that. Cancel. But remember legally, legally we received an order to cancel. Then we can cancel the financial liability. That is the meaning of cancel. Next one, expire. Expire means what? Expire. We achieved the end of the period. Right? Suppose we have issued, let's say, preference shares or as bonds. 5 years we issued for 5 years. Then we came into the 5th year. Once time is going, right, our liability is expiring. So that is the meaning of expire. Okay? Discharge, cancel, and expire. Okay. Here you can write delivered cash. Delivered cash. Or else you can write example that I have mentioned. Delivered cash in sense we settle money. Here you can write entity legally released from obligation. Legally released from obligation. Legally released. Last one. Expiring due to passing the time. Due to passing the time. Okay, complete this summary. So this part completed. Recognition, initial recognition of financial instrument. In this side we discussed derecognition of financial instrument. We divided into two, financial asset and financial liability. So financial asset basically we discuss on two circumstances: contractual right to receive cash flows expire. Then second one, transfer of asset. On that, risk and rewards transferred we measured through decision tree, right? And when it comes to financial liability, discharged, cancel and expire. Those are the three circumstances where financial liabilities derecognized from the books of financial statement. Okay, now we need to discuss classification of financial asset as well as classification of financial liabilities. You can write down classification of financial asset. We'll focus on that first. We'll write classification of financial instruments. Already we have classified based on LKS 32, right? So that one, financial asset, financial liability, again could be classified based on SLFRS 9. Financial asset. Okay. Financial liabilities. Okay. So now we are here, financial asset classification. Basically there are two models, right? There are two things to be considered. First one, business model, right? Business model. We need to look at business model, right? So in business model, we need to keep the financial asset in order to, contractually we need to collect money, Contractually we need to collect money. That is the business model, right? Sometimes the business model is to keep the financial asset, and the cash flows would be collected through selling, right? Cash flows would be collected through selling. The financial asset would be sold. For an instance, share investment. We will be selling it outside, right? Then cash flows would be, that's why we are keeping. Maybe that is depend on the business, right? That is depend on the business. So business model is to keep in order to collect cash flows. Okay? So that is the business model. Okay? Business model. On the other hand, contractual cash flow characteristics. Contractual cash flow characteristics. We need to look at contractual cash flow characteristics. Contractual cash flow characteristics. Okay. Now, based on these two conditions, we need to classify financial asset into three. Financial assets into three. 1, 2, 3. What is the first one? Amortized cost. In amortized cost method, we need to look at both aspects, business model as well as contractual cash flow characteristics. Contractual cash flow characteristics. What do you mean by contractual cash flow characteristics? You know, in contractual cash flow characteristics, we need to look at the principal and the interest. Principal and the interest payments. Right? Someone would be paying. So those are collected by the entity. Right? Those are collected by the entity. Suppose we have invested on FD. Right? There is a principal amount. Let's say 100,000. We need to keep this 100,000 for 5 years. Annually or once in 3 months we will be receiving interest. Sometimes the same interest would be added into the FD itself. That is based on the requirement or choice of the investor. Right? But here you can understand there is a cash flow. In the contract, in the agreement, there is a cash flow. Right? Interest, and at the end of the 5th year, we need to recover this 100,000. Right? That is called principal amount. Principal and the interest, the cash flow, right? Contractual cash flow characteristics. We need to understand. Okay? If we are going to, classify under amortized cost. Now, before classification, I would like to mention examples of financial asset, right? Let's say share investment. Second one, FD. Third one, loan given. Maybe staff. Fourth one, debtors. Fifth one, let's say we have given loan given to outside, we can say staff loan. Entity has provided loan to staff, so receivable. Share investment, FD, loan given, debtors. Then investment on treasury bills. Sixth one, investment on treasury bills. Seventh one, investment on treasury bonds. Then the share investment. No. Sometimes share investment on two purposes. First purpose is profit making. profit making. So today we buy and tomorrow we can sell if prices are going up, right? Another one is holding for longer period, holding for longer period. This purpose, the investing on shares is not for profit making, but for keeping them in order to, sometimes get the control of the entity, maybe the long-term investment, right? Long-term. So these are the set of examples on financial asset, right? Now we are talking about the classification of financial asset. Now we need to look at the business model as well as the contractual cash flow characteristics. Contractual cash flow characteristics. In amortized cost, what we need to look at? We need to look at both models, business model as well as contractual cash flow characteristics. Contractual cash flow characteristics. Okay? Contractual cash flow characteristics. Okay? Amortized cost. If we are complying with these two, then we can classify those things as amortized cost. Now look at the textbook, page number 8. Not page number 8, page number 10. Page number 10. Page number 10. Highlight, take your highlighter and highlight. So same thing is mentioned, right? Same thing is mentioned. So this is a summarized version. You will be able to understand. In amortized, if we are using amortized cost classification, we need to see the both aspects, business model and the contractual cash flow characteristics. In this case, interest and the principal amount need to be recovered, right? Those are the cash flows. Okay, read first 2 bullet points under amortized cost. The financial asset is held within the business model, underlying business model, whose objective is to hold the financial asset in order to collect the contractual cash flows. Right? That is the business model. Second one, read the second bullet point. The contractual terms of financial asset give rise on specific dates to cash flows that are solely payments of the principal and interest on the principal amount outstanding. Right? We need to keep, in this case, we need to keep until maturity. Right? We are not going to sell in between. Right? If we are going to sell in between, we cannot use amortized cost. Then we need to shift on to second one, fair value through OCI. Fair value through OCI method. We need to shift into second method. Right? Okay, so that's what you need to understand. This is very critical. Okay, business model, contractual characteristics. If we are not complying with these two, we need to shift into here. Right? Fair value through OCI. Suppose we are going to invest shares on equity shares. We are going to invest on equity shares, but short-term purpose. Can we classify, because there is no such, cash flow things, no? Interest, principals, no, right? In the share investment, there is no such contractual cash flow characteristics. Therefore, we cannot classify them as under amortized cost. Share investment cannot. Right? Share investment cannot. Now you need to understand share investment. I already told you there are two purposes, profit making and holding for long time. Right? If we are investing shares for short term profit making, that is motive is to make profit on selling, buying and selling, you are not allowed to measure, you are not allowed to classify under fair value through OCI. Right? What is the remaining one then? What is the remaining one? Fair value through P&L. Fair value through P&L. Fair value through P&L. Okay? Fair value through OCI, fair value through P&L. Okay. Now we'll look at in detail about fair value through OCI. Fair value through OCI. Okay? First we checked with amortized cost. Now you can understand the characteristics of amortized cost. There should be a business model to hold the receive contractual cash flows. Then there are contractual cash flows, interest and the principal amount. Okay. But in this case, here also we have a business model, right? Business model. Business model. Here also we need to use the business model. We are keeping these financial asset in order to collect cash flows. In order to collect cash flows, right? But try to understand business model for both what? Read page number 10, both collecting contractual cash flows and selling financial asset. Collecting contractual cash flows and selling financial asset. Selling financial asset. This is very, very important. Second bullet point, contractual terms, this one, contractual cash flow characteristics. Contractual cash flow characteristics. Contractual cash flow characteristics. Can you please write down this one? Contractual cash flow characteristics remain unchanged, similar to this. Okay. But this one very important. In the business model, maybe we might keep this one in order to collect contractual cash flows, as well as we would be collecting cash flows by selling the financial asset. By selling the financial asset. Okay, that's important. Sometimes the second one is cash flow characteristics also available. Right? Cash flow characteristics also available. Maybe interest, maybe principal, right? The similar. Okay, I already told you, if we difficult to keep until maturity and we have intention to sell and recover money, then we cannot write under amortized cost. We need to record under fair value through OCI. Right? That's why they have given two options. Right? The basically, if we have invested on shares for long-term purpose, shares on long-term purpose, this one, then we need to record under fair value through OCI. Why? There is no such interest and the capital, interest and the principal payment in the share investment. Right? In that sense, we need to use fair value through OCI. But if we are selling, if we are investing on shares, ordinary shares, our intention is to sell very quickly, motive is to make profits, then you are not allowed to classify that particular investment under fair value through OCI. It should be recorded in fair value through P and L. Fair value through P and L. Okay? Here you can write equity investment. Here you can write here equity investment not held for trading, not held for trading. Okay, equity investment not held for trading. I hope you understood. Don't mix up. Equity investment not held for trading, that means long term purpose, we can record under fair value through OCI. Right? Then what is fair value through P&L? Now we have discussed amortized cost, fair value through OCI. Then this is the balancing figure. Any other financial asset need to be recorded fair value through P&L, right? All other financial assets. All other financial assets, right? For an instance, equity investments for trading purpose. Equity investment for trading purpose. Did you understand? This is the classification. I hope you understood. Right? Now, shall we do a past paper? Shall we do a past paper on this classification? This classification. 2018 December question number 7C. December 2018 question number 7C. Let me read the question. explain how the financial asset mentioned in 3 above should be classified as per SLFRS 9 financial instruments. Okay. Explain how the financial assets mentioned in 3. Now we'll read 3. Here 3. There are 3 explanations given. So we'll read one by one. Win PLC holds the following financial asset as at 31st March 2018. Portfolio of investment. Portfolio of investment in treasury bonds. Portfolio of investment in treasury bonds. Win PLC hold these bonds to meet capital expenditure, and it manage these bonds to collect interest and the maturity values. Right? Now you might think this is, in the business model as well as the second contractual characteristics also fulfill, right? Interest and the principals are available. Read next one, next sentence. When an opportunity arises, it will sell these bonds to the reinvest in financial assets which in higher return. That is most important sentence, right? That is the decision. Your decision will be changed on that particular sentence, right? Can you record that one, or can you classify that one under amortized cost? What do you think? Can or cannot? Business model, yes. There is a contractual right to receive cash, right? Interest and the capital. But the second sentence they are telling they have option to sell in between. Once chance received, they will sell. Then can you record under amortized cost? No, cannot. So you need to shift into second method, fair value through OCI. Fair value through OCI, right? We'll write it quickly. Okay, we'll write. Before shifting into the 3 items, we'll write, some explanatory note. Classification of financial assets should be based on, write down. Classification of financial assets should be based on. Classification of financial assets should be based on. Classification of financial assets should be based on the entity's business model for managing the financial asset and the contractual cash flow characteristics of the financial asset. Business model and the contractual cash flow characteristics of the financial asset. Now we'll write treasury bonds, right? First investment is treasury bond, no? Put a 1. Because when you write your answer, you should answer clearly. If you are given numbers, please use the numbers, right? Please use the numbers, because people are checking your answer script. So you need to give clear answers. So last couple of weeks I marked question papers in my university students, right? My university students. Some students have written answers together, even though the question paper clearly states categories by dividing in through the numbers, sub numbers. But some students, very few students have written together without considering these sub numbers. Then when we mark the question paper, it's very difficult. It's very difficult, right? Imagine how many papers are marking by a person. Is that only your paper? No. Right? So think on that way. So you need to present nicely. question answer script. Answer script. Please keep those things in your mind, because those are the tips in order to, get through the examination. Tips. The knowledge is, yes, important, 100%. Right? These tips also need to be used or helpful for your examination when you write. Okay. First one, we'll write answer. Now we have discussed. The business model is collecting contractual cash flows. The business model is collecting contractual cash flows. The business model is collecting contractual cash flows within bracket interest and principal amount. Interest and principal amount. Business model is collecting contractual cash flows and selling them. And selling them. And selling them. That is the important. And selling them. Underline that, selling them. Because of that, we need to go to second model, fair value through OCI. If assesses the bond, if assesses the bond on an ongoing basis to maximize the return, ongoing basis to maximize the return until a capital expenditure, need arises. Until capital expenditure need arises. Until capital expenditure need arises. Why? If they receive the chance, they will sell. They will sell. Right? Therefore, these bonds should be classified as, financial asset under the classification of fair value through OCI. Fair value through OCI. Fair value through OCI. Right. Fair value through OCI. Let me read the second one. Investment in equity shares of different entities. Win PLC manages the overall return on the portfolio by both holding and selling shares. Both holding and selling shares. Holding and selling. That means their intention is to what? Intention is to, if the prices are going up, they will sell. Right? They will sell. So simply we can write fair value through P&L. Write down. Investment in listed equity shares of different entities. Investment in listed equity shares in different entities. Do not have the contractual cash flow characteristics. Do not have the contractual cash flow characteristics. The business model is to maximize the overall return. The business model is to maximize the overall return by holding and selling. The business model is to maximize the overall return. Business model is to maximize the overall return by holding and selling them. Thus, these instruments are classified as financial assets under the classification of fair value through P&L. Fair value through P&L. Third one, receivable portfolio. Receivable portfolio. Debtors, in simple terms, debtors. Win PLC is very careful about the recoverability of these receivables and attempts to recover receivable amounts on due dates. Each debtor has been granted with 30 days credit period by contacting debtors through mails, telephone or other methods. Right? Now, receivables. How we are going to classify receivables? How we are going to classify receivables? Can you classify receivables as fair value through P&L? No, cannot. First we need to check whether we can use amortized cost. That is the first priority. You need to check the business model as well as contractual cash flow characteristics. Business model as well as contractual cash flow characteristics. Business model is what? We need to collect money from the debtors, right? That is the business model. Okay. Contractual cash flows. Are there any contractual cash flows? Yes or no? Yes or no? Yes, there is a contractual cash flow, right? Maybe there is no such interest, but the amount that we have granted would be collected, no? Right? As per SLFRS 15, we are recognizing revenue. In the transaction date, when performance obligation is transferred from seller to buyer, then we can collect, we can recognize the revenue. if we are selling credit basis, the debtors need to be identified, right? Debtors need to be identified. Okay, so debtor, particularly debtor, should be measured or recognized as financial asset. Now they are asking in which category: amortized cost, fair value through OCI, or fair value through P&L. So we need to check the characteristics. We need to check the characteristics. Amortized cost, there are two, business model and the cash flow characteristics. Now you can understand both characteristics, both methods, both items are satisfied, right? So we can record debtors under amortized cost. Amortized cost. Write down. The business model is to hold these receivables to collect. The business model is to hold these receivables to collect the contractual cash flows, and the business model is to hold these receivables to collect the contractual cash flows, and these shares, these financial assets should be classified. These financial assets should be classified under amortized cost. Under amortized cost. Under amortized cost. Okay? Under amortized cost. Because business model is satisfied. Business model is satisfied because we are keeping that debtors in order to collect cash flows, right? 100% we don't have interest and the principals in this case, but the business model is satisfied, no? Therefore, we can record under amortized cost. Okay, right? That is the answer for the December 2018 question number 7C. Now you can understand those classifications already tested, right, by the examiners. Maybe same type of question can be repeated. Same type of question can be repeated. So you need to focus on that. Okay. Read and understand the concepts, the classification. Okay. Shall we discuss financial liability classification? That is not difficult as such, but financial liability financial liability classification. Basically, financial liability classification on two. What are those two? Financial liability classification. Already I mentioned in the previous explanation, I mentioned the classification of financial liability. What are those two classifications? Amortized cost and fair value through P&L. Amortized cost method and the fair value through P&L. Fair value through P&L. Okay. Amortized cost and fair value through P&L. Now in amortized cost, we have to have what? Cash flow characteristics. Cash flow characteristics. Okay. Cash flow characteristics should be there. Interest, principals, then based on that we have calculated, no? Already we have calculated financial liability today. In that we recorded interest expenses, and we have taken the present value of cash flows. Likewise, we have done something on this, right? So that is the method of amortized cost, right? Amortized cost. Okay. Write down these two methods. Now how we are going to differentiate these two? If we are keeping some financial liability for trading purpose, if we are keeping financial liability for trading purpose, use fair value through P&L. All other financial liability should be recognized or should be classified under amortized cost. Did you understand? Yes? Okay. Now I need to discuss small thing. Not small, that's very important part, important thing, right? Since I have this picture or the classification, I would use the same classification in order to explain that. Then after discussing this, we'll move on to financial asset, right? Now I'm going to teach you initial measurement and subsequent measurement. 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 Amortized, in this case, initial measurement should be at what? If we are using amortized cost basis, initially how we are going to measure financial liability if we are using amortized cost? Fair value. Fair value. Here, obvious, this is also fair value. Right? Now we are in here, fair value, right? In the same place, we should identify if there is a transaction cost. If there is a transaction cost. Transaction cost. When we issue debentures, let's say when we issue bonds from the business, we need to pay some legal fees, stamp duties. Those are called transaction cost, right? How we are going to record those transaction costs in initial measurement? Initial measurement. Transaction cost here, how? Remember, transaction cost need to be added to the financial liability itself, right? Financial liability. Remember, we need to take that the transaction cost, the same financial liability itself. For an instance, look at this financial liability. Suppose we have issued a bond. Initial, fair value of the bond is 1,000 rupees. We collect money, 1,000 cash debit, financial liability credit. Suppose we have paid 100 rupees as stamp duties. What is the double entry? What is the double entry? We have paid 100 stamp duty. What is the double entry? Cash credit, financial liability debit 100. Here cash. So the net amount would be the initial measurement or initial value of the financial liability. That means 900. If you can use the double entries like this, or else you can write 900 the net figure, no problem. 900 net figure, right? That's what I said, transaction cost, financial liability itself. But in this case, fair value through P&L, if there is a transaction cost, how we are going to record? Transaction cost should be charged to P&L, right? Transaction should be charged to P&L. Okay? Did you understand? Yeah. Okay. Financial asset. Financial asset. Now we are talking about what? Measurement, right? We are talking about measurement. We are talking about measurement. Financial asset measurement. Here, fair value through P&L. We'll take that one first. Fair value through P&L. Fair value through OCI. Amortized cost. Initial measurement. Initial measurement. Okay. Fair value through P&L. How we are going to measure initially? How we are going to measure initially? How we are going to measure initially? Fair value through P&L, that's obvious. Fair value. Right? Initial measurement should be at fair value. Transaction cost. Yes, transaction cost. If we are using fair value through P&L, we should charge to P&L. Fair value through OCI, initial measurement should be at fair value. Fair value. Transaction cost. No, asset itself, right? the investment financial asset itself, right? Financial asset itself. Okay. In amortized cost, initial measurement should be at fair value. Transaction cost, financial asset itself. Okay, financial asset itself. Okay, I hope you understood. If there is a transaction cost, we need to record in the financial asset itself, both fair value through OCI as well as amortized cost. But in addition, on the other hand, fair value through P&L, we can charge transaction cost into P&L. That is the difference. You need to understand that. Okay. Then we'll discuss about what? Then we'll discuss about subsequent measurement. Subsequent measurement. Okay. Fair value through P&L. It's obvious. Subsequent measurement should be at fair value. Fair value. Okay. Subsequently also we need to measure the fair value. The fair value changes. Fair value changes. Where? P&L. Fair value changes should be charged to P&L. Okay. Fair value changes should be charged to P&L. Here, subsequent measurement should be at fair value. Fair value changes, OCI. That's why we say OCI, no? Fair value through OCI. Fair value changes should be charged to OCI, right? Fair value changes should be charged to OCI, but remember, there is a classification. There is a classification. What is that classification? Now, you have two types of shares, no? Equity instruments and debt instruments, right? Here, we'll write on that way. Subsequent measurement, we have two, no? Right? We have two. Equity instruments. Second one, debt instruments, no? Equity instruments, debt instruments. We can invest on equity instruments as well as debt instrument. Right? If we use this method, fair value through OCI, if we have invested on fair equity instruments, right? Will this one write, fair value change, P&L, right? If equity instrument fair value changes, how we are going to charge? How we are going to charge? OCI, but remember, we'll write in red color, but no reclassification to P&L. There is no reclassification option, right? OCI not reclassified to P&L. OCI not reclassified to P&L. Right? OCI not reclassified to P&L. That is important, right? Equity. Debt instruments, we can reclassify. Right? Here also into OCI, into OCI, but only thing is what? Within bracket we can write, OCI reclassified to P&L. right? Here not classified now. Here OCI reclassified to P&L, right? So keep that in your mind. Okay. Any other interest and all? Because sometimes we have the previous example in the past paper question, you have noticed debt instrument, right? During that selling, before that selling, maybe we are receiving interest and all. So interest and all, where it should be charged? P&L, right? Interest, dividends, everything should be charged in P&L, right? Okay? Right. What is the next one? Amortized cost. Amortized cost. Amortized cost. Subsequent measurement should be at what? Fair value? No. We are not going to measure fair value for amortized cost, because we take present values, all the cash flows, then year by year we need to increase the interest, right? That means subsequent measurement should be at amortized cost. Should be at amortized cost, right? So here we are generating interest. Interest should be charged to P&L. Interest should be charged to P&L. Okay. This is the summary. This is the summary. Okay. Then what we can do is, here I forgot to write in interest, EIR, effective interest rate. EIR, effective interest rate. Okay. Now shall we do question number 2 before winding up? Before winding up, we'll do question number 1 in the tute. With that explanation, you know, practice question number 1 and practice question number 2, practice question number 3, practice question number 4. Yes. Practice question number 4. Even practice question number 5 also we can discuss. Right? Even practice question number 5 we can discuss, because we have discussed. But how to do the amortized cost in subsequent measurement and all, we need to practice through a sum. Right? What we are going to do? Can I give those things as homework? Yeah. Okay. Before winding up, can you please write down past papers on financial instrument, SLFRS 9, December 2018 question number 3, December 2018 question number 3, June 2017 question number 3 part A. Here this question already we have discussed. These 2 questions as homework. These 2 questions as homework. I will be discussing next session, right? I will be completing financial instrument standard by completing all the past papers, right? After that, what we can do is we can start consolidation. We can start consolidation. Because that is the main or important standard, right? Important topic in your examination, right? You can earn many marks on consolidation. Okay, therefore we'll focus on consolidation once we complete these financial instrument standard. Financial instrument standard also very important, right? So I hope you understood the discussed points, right? Okay. Then with that, I'm going to conclude today's session. Before winding up the session or concluding the session, I would like to give the recap what we have discussed from the morning, right? What we have discussed from the morning. From the morning, we discussed LKS 36 impairment. Couple of past papers we discussed. Then after that we started LKAS 32, financial instrument presentation. Okay. Under that we discussed, we completed with all past papers, right? We defined financial instrument, we defined financial asset, financial liability, financial equity, right? Then we classified. Now there is some practical issue when classifying financial asset and financial liability. Financial liability and financial equity, right? Financial liability and financial equity. In that sense, in financial instrument standards, set of standards, already I told you, we need to focus on substance rather than the legal form, right? Substance rather than the legal form, right? In that sense, we discussed how to classify financial asset and financial liability component, okay? Especially on convertible securities, okay? That is called compounded financial instruments, First priority is given to measure the liability component, then we need to take the balancing figure as financial equity component, right? Then we completed that one with past papers. Then we shifted into SLFRS 9. In SLFRS 9, we classified financial asset and financial liabilities. Before classification, we discussed the recognition of financial assets as well as derecognition of financial assets. Recognition of financial asset as well as derecognition of financial asset. On the other hand, recognition of financial liabilities and the derecognition of financial liability. That's important, right? Then we classified financial assets into 3. What are those 3? Yes, gentlemen? What are the 3 classifications? Amortized cost, fair value through OCI, and fair value through P&L. When it comes to financial liability, fair value through P&L, and all other liabilities need to be recorded under amortized cost, right? And we discussed the measurement basis, initial measurement and the subsequent measurement also. I think you can remember them because recently we discussed. Therefore, I'm not going to touch that again. So with that, I conclude today's session. Thank you very much for watching this online video. I hope this will helpful for your, for enhancing your knowledge, enhancing your thinking, enhancing your skills in chartered career, right? Okay, with that, thank you very much. See you soon.